Hello, class. Welcome to Chapter 3, Gross Income Inclusions. In this chapter, the learning objectives are to explain the differences between the economic, accounting, and tax concepts of income, explain the principles used to determine who is taxed on a particular item of income, determine when a particular item of income is taxable under both the cash and accrual methods of reporting. You will also learn to apply the rules of Section 61 to determine whether items such as compensation, dividends, alimony, and pensions are taxable. Describe tax planning conditions for inclusions of gross income. Describe compliance and procedural considerations for gross income. The accounting concept of income usually is measured when it is realized. Values are measurable when there is transactions. Example, sales price and basis can be determined during a completed transaction. Accounting concepts of income. Realization. So realization, you're going to have the transactions with a second party, severance and economic interest in property. Tax concept of income. You have economic benefit, realization of income, and recognition of income. Purposes of income taxes: administrative convenience, wherewithal to pay. Gross income is income from whatever source derived. All ascensions to wealth are considered income unless specifically excluded. This includes the fair market value of goods or services received in barter transactions. Different types of items for gross income are wages, business gross income, gains from property sales, interest, rents, royalties, dividends, alimony through 12/31/2018. As we'll learn, if you are divorced after on 1/1/2019, it will no longer be included. You also have annuities or pensions and trust and estate income, to name a few more. Here we're looking at the Form 1040, and you'll see where the income up here, here's your gross income items, and that would get you to, you had your salary and wages, you had your tax exempt interest of $500, but the taxable income is $4,000. So you're going to add them up, and that's how you're going to get the $122,000. So that is going to be your total income before any kind of adjustments are made. On Schedule 1 of the tax return, you're going to see here is additional income that is broken out. This is going to be coming from, you're going to have it come over here from Schedule 1, any other additional items on line 6. So you will see that that's going to be also plugged in along with these other items. So here is your list, different items of income that would be coming in. And then down here is where your adjustments are to back out. Once you take your income and then you back out your adjustments, that is how you're going to have your adjusted gross income, your AGI. The assignment of income. Individual providing services is required to recognize income even though he may have assigned the right to receive the income to another. Income from property, example, interest or rent income, should be taxable to the owner of the property. Okay, so individual providing services is recognized. That would be on the accrual basis. Is once you have your services all rendered, that's when you would recognize your income. You would recognize it even though it may have been assigned to someone else. So you may have something where you may have rental income but you may give it to a family member, may receive the rental income, you would recognize that income. That is yours. You can give them the money, but it's going to be taxable to you. Allocating between married couples, you have common law, which is income tax to the spouse who earns the income, 41 states, and then community property states, that's property acquired after marriage, is split 50-50, and that's in 9 states. Earnings of a minor child, income earned by minor child is taxed to the child, not the parents. This applies to wages or investment income earned by child. Child's investment income may be subject to kiddie tax, which we also started to cover in Chapter 1. Cash method of accounting, income recognition. Generally, income is recognized when actually or constructively received, not earned. So an example on that would be if you work in sales and if you reach your threshold to your bonus level and you're going to be paid a bonus, even though you earned it in 2019, but you're not paid until they hand out bonuses sometime in the first quarter of 2020, that's when you would recognize it and it would go on your 2020 income. Income could be in the form of cash, property, or services. Non-cash items are valued at fair market value. Constructive receipt, income is made available to the taxpayer who has power to draw on it. No constructive receipt if taxpayer has substantial limitations in power to access income. So constructive receipt, which is important, is you may receive a check in the mail from a client that you did services for, and you may receive it on 12/31 and decide, you know what, I'm okay. I don't want this recognized in 2019. I'm going to make the bank deposit on January 2nd. Well, technically, because you received it in the mail and it's in your hand, it is actually 12/31 income. Okay. Again, no constructive receipt if taxpayer has substantial limitations in power to access the income. We go back to the bonus example that I used for that last slide. If it wasn't paid to you and it wasn't given out, it would not be receipt to you if you don't actually have it in hand. Exceptions to recognition of income when actively constructively received. You have the Series EE bonds. You have farming and ranching income. Small taxpayers exceptions for inventories. The accrual method, that's when income is recognized when earned. Right? Goods and services have been provided. So think about on that would be a doctor's office. If you are dealing with anybody, if you have accounts receivables, you could use the accrual method. Earned is defined as all events have occurred to fix the right to receive the income. Amounts can be determined with reasonable accuracy. The exception is prepaid income recognized when received. So if you are a landlord and you are renting, someone goes and pays you 3 months in advance, you're going to record that income when you received it for the 3 months. But the renter would not recognize that expense until those months have passed. So if you receive money in December for January, February, March, it is income to you. You received it. But on the payer side, the one who's actually renting, they will only recognize the expense. They're going to have to recognize the expense in January, February, March. Exception to the exception. You can defer recognition for prepayment of goods if tax accounting equals finance accounting. Can defer recognition if prepaid services. Must recognize revenue associated with services provided in year 1. Remainder must be recognized in year 2, irrespective of when services are provided. Okay, so if your tax accounting equals your financial accounting and you're on the accrual method and you had deferred revenue, then you would have deferred revenue and you would record that revenue over a period of time in the future months. That's on the accrual method. Items of gross income, you have compensation, payment for personal services, business income, trade or business income received less of cost of goods sold, if any, gains from sales of property. Gross income interest, you have interest is the compensation obviously used for money, interest you receive from bank accounts, includes interest revenue from corporate bonds, mortgages, life insurance policies, and bank deposits, excludes tax-exempt interest, and the exception of recognition of interest income is the Series AA savings bonds. Series E savings bonds exemption. The interest income from the EE bonds can be excluded if taxpayer meets all of the following. Bonds were purchased after 1989 by taxpayer 24 or older. Bonds must be purchased and can't be a gift. Bonds proceeds must be used for tuition and fees. Tuition and fees first reduced by exempt scholarships, veterans benefits, and education credits. Married filing joint. You have to do that. Okay. The Series E savings bonds exclusion is completely phased out after taxpayers Magide 96,100 or 151,600 for married filing joint. Okay, so that is the AGI modified. The AGI is including interest income in there. All right, to get your exclusion. If qualified education expenses are less than the Series E principal, then only the interest is excluded. All right, so you have the excluded EE interest times the qualified education expenses divided by the interest plus principal. Okay, this is going to conclude the first part of Chapter 3. I will continue in another presentation for Part 2 of Chapter 3. Thank you.